Welcome back to the channel. Today, we're diving into 19 Rules for Getting Rich and Staying Rich by Eugene Kelly. Now, before we get started, if you're looking for a little extra motivation on your own financial journey, check out affirmifyjourney.com for personalized zodiac affirmations that can really boost your financial confidence. Okay, back to the book. I've been flipping through these notes and excerpts, and I have to say, Kelly's approach is refreshingly straightforward. It's less about Wall Street jargon and more about building a rock-solid financial foundation.
It's fascinating how Kelly cuts through the noise and dispels those common Wall Street myths that often lead people astray. You know, those ideas about getting rich quick or predicting the market? He throws those out the window.
Exactly. It's like he's saying, forget the hype, let's focus on what really works. I'm already sensing this is going to be less about risky gambles and more about building wealth strategically brick by brick.
That's precisely it. He emphasizes that no one can predict the future. So those strategies, based on market timing or trying to outsmart everyone else, are inherently flawed. Instead, he advocates for a disciplined, long-term approach centered on owning valuable assets and generating that consistent cash flow.
So it's less about hitting the jackpot and more about building a steady stream of income that grows over time.
Precisely. He uses the analogy of a tree growing slowly but steadily over decades. You wouldn't expect a tree to sprout overnight and bear fruit instantly, right? It takes time, nourishment, and consistent care.
That's a great analogy. And it makes me think about those times I've gotten impatient with my investments. I'm definitely guilty of wanting to see those quick returns. But Kelly's approach seems to be more about planting those seeds and nurturing them patiently.
Exactly. And that brings us to one of the book's core concepts, the total return strategy. This idea resonates with me because it prioritizes both investment income, like dividends and interest, and potential capital appreciation. So your portfolio isn't just sitting there. It's actively working for you, generating income, while also having the potential to grow in value over time.
Okay, hold on. I need to unpack this a bit. So imagine you're nearing retirement. Wouldn't it be amazing to have your portfolio generating income, like a regular paycheck, even if the market isn't doing well? Is that kind of what the total return strategy is aiming for?
That's a fantastic way to put it. It's about having those consistent income streams, even during those inevitable market downturns. It's like having a financial safety net that helps you stay the course and avoid making those rash decisions based on fear or panic.
Okay, that makes a lot of sense. It's about having a more balanced approach, right? Not putting all your eggs in one basket and hoping for the best.
Absolutely. Kelly emphasizes that a well-rounded portfolio should generate income while also having the potential to grow. He compares it to a river with multiple tributaries all feeding into a larger stream.
I like that. So even if one tributary dries up, the river keeps flowing. Now, another concept that really intrigued me was the investment pricing pendulum. It sounds almost like a mystical tool, but I'm guessing it's more about understanding market psychology.
You're on the right track. Think of it this way. Imagine a pendulum swinging back and forth. On one side you have fear, and on the other, greed. These emotions drive market sentiment, influencing how people buy and sell assets.
Okay, I'm starting to see the picture here. So when fear takes over, prices drop, even if the underlying asset is still fundamentally sound. And when greed kicks in, prices can become inflated, leading to those bubbles that eventually burst. Am I getting this right?
Precisely. And Kelly argues that understanding this pendulum swing is crucial for making smart investment decisions. It's about recognizing those moments of extreme fear or greed and using them to your advantage.
So if you can spot those times when fear is driving the market, you might be able to snag some great deals on assets that are temporarily undervalued. It's like shopping the clearance rack at your favorite store.
That's a brilliant analogy. It's about having the discipline to wait for those opportunities and the courage to act when everyone else is panicking. Now knowing when to buy is key. But what should you be buying? Kelly outlines 4 key asset classes that every investor should focus on.
All right, let's hear it. I'm guessing this isn't just about throwing all your money into the latest tech stock and crossing your fingers.
You're right. He advocates for a balanced approach. The first asset class is one that might surprise you. Cash reserves.
Really, cash? I thought this was about building wealth, not stuffing it under the mattress.
I understand your skepticism, but Kelly's point is that having a separate emergency fund is crucial for weathering those unexpected financial challenges. Life happens, right? Cars break down, medical bills pile up, jobs can be lost. Having that cash cushion prevents you from having to sell your investments at the worst possible time.
Okay, that makes a lot of sense. It's about having that safety net, so you don't have to make those panicked financial decisions when you're already stressed out.
Exactly. Think of it like this. Your cash reserves are your financial shock absorbers, protecting you from those unexpected bumps in the road. Now, the second asset class is one you're probably familiar with: real estate.
Ah, real estate.
Yeah.
Owning a home is a dream for many people, including myself.
And Kelly is a big advocate for homeownership. He sees it as a powerful way to build equity over time, especially if you're disciplined about paying down your mortgage. Plus, it provides a sense of security and stability that other investments might not offer.
I can definitely see the appeal of that. It's about putting down roots both literally and financially.
Now, the third asset class is fixed income securities. We're talking about things like bonds and preferred stocks. These investments can provide a steady stream of income and act as a ballast for your portfolio during those volatile market periods.
So they're like the anchors of your portfolio, keeping things steady when the seas get rough.
Exactly. And this raises an important question. How do you construct a fixed income portfolio that generates that consistent cash flow while also providing stability? Well, Kelly dives into the specifics of choosing the right bonds and managing those interest rate risks.
I'm definitely going to need some guidance on that. Bond investing always seemed a bit mysterious to me.
Don't worry. We'll get into those details later.
Yeah.
Finally, we have common stocks. This is where you can potentially see significant growth in your portfolio over the long term, but of course it comes with more risk.
Stocks are definitely the ones that get all the attention, both good and bad. They can be exciting, but also a bit nerve-wracking.
You're spot on. And that's why Kelly emphasizes techniques for selecting undervalued companies with strong fundamentals and a history of paying dividends. He's not advocating for speculative bets on high-flying growth stocks. He's looking for solid companies with a track record of success.
So it's less about chasing the latest trends and more about finding those steady performers, those companies that are built to last.
Precisely. He compares it to choosing a sturdy oak tree over a flimsy reed. The oak may grow slower, but it's much more likely to withstand the storms.
Okay, those four asset classes provide a solid foundation, but I know from experience that there are plenty of personal risks that can trip us up along the way. What are some of the common pitfalls that Kelly warns about?
He hits on some really important points here. One of the biggest is lack of discipline. It's so easy to get caught up in the excitement of the market or make emotional decisions based on fear or greed. But Kelly stresses the importance of sticking to your investment plan and avoiding those knee-jerk reactions. I remember a time when...
Hold that thought. It sounds like we're about to get into some juicy stories and practical tips. Why don't we take a quick break and come back to dive into those personal risks and how to avoid them?
You were about to share a personal anecdote about a time when you made an impulsive financial decision.
Oh, right. Well, it wasn't exactly Wall Street level, but a few years back, I got swept up in the hype of a new cryptocurrency. Everyone was talking about it, and the price was skyrocketing. I didn't really understand the technology or the fundamentals, but I thought, hey, this is my chance to get in early and make a quick buck.
We've all been tempted by those shiny objects, so what happened?
Well, I threw a chunk of my savings into it, more than I could comfortably afford to lose. Of course, as these things often go, the bubble burst. The price plummeted, and I ended up losing a significant portion of my investment.
Ouch, that's a classic example of what Kelly warns against, letting emotions drive your investment decisions.
It was a hard lesson learned, but it definitely solidified the importance of discipline and sticking to a well-thought-out plan. I realized that chasing those quick wins can often lead to bigger losses.
Kelly couldn't have said it better himself. He emphasizes the importance of establishing a systematic approach to saving, what he calls paying yourself first. It's about setting up automatic transfers from your checking account to your investment account, so saving becomes a built-in part of your financial routine.
It's like putting your savings on autopilot, right? You're not waiting until the end of the month to see what's left over. You're making saving a priority from the get-go.
Exactly. And he emphasizes starting small and gradually increasing the amount you save as you become more comfortable with the process. It's about building those savings muscles over time.
Slow and steady wins the race, as they say. Now, I'm curious about Kelly's thoughts on leverage. He seems to have a very specific view on when borrowing money is justified.
You're right. He believes that there are only two situations where borrowing money is justified: for purchasing a primary home or investment real estate, and for funding or establishing a business. He sees leverage as a powerful tool that can amplify both gains and losses.
But isn't that a bit restrictive? What about using leverage to invest in the stock market? Don't some people make a lot of money doing that?
He cautions against it. He sees it as unnecessarily risky, especially for those who are still building their financial foundation.
Yeah, that's a pretty clear message. So when it comes to a mortgage, I know Kelly specifically recommends a 30-year fixed-rate mortgage. Why is that? Isn't that a long time to be locked into a single interest rate? What if rates drop significantly?
He emphasizes the importance of locking in a fixed interest rate for the long term. This provides stability and predictability, allowing you to plan your finances with confidence. He sees those adjustable rate mortgages or shorter term fixed rate mortgages as introducing unnecessary risk, potentially exposing you to payment shocks down the road.
That makes sense. It's about having those predictable payments, especially when life throws those curveballs. But let's say you don't plan to stay in your home for 30 years. Does a 30-year mortgage still make sense?
Kelly believes it offers the most flexibility. If interest rates drop, you can always refinance, but he advises against cashing out equity when you refinance. Instead, he recommends refinancing the loan balance with a new 30-year mortgage. This lowers your monthly payments while preserving your financial security.
So it's a long-term strategy, even if your living situation might change. It's about using leverage strategically to build wealth, not to put yourself at risk.
Precisely. And this leads to his strong stance against borrowing money for investments other than a home, investment, real estate, or business. He sees those investment schemes where you put up part of the money up front and the rest later as red flags.
It sounds like he's trying to protect investors from those situations where leverage can backfire.
Absolutely. He's all about minimizing unnecessary risks and building wealth on a solid foundation. And speaking of minimizing risks, Kelly is a big advocate for avoiding credit card debt.
Credit cards can be so tempting, though. It's so easy to swipe that card and worry about the consequences later.
He acknowledges that they can be a convenient tool for managing short-term cash flow, but he stresses the importance of paying off your balance in full each month. Otherwise, those exorbitant interest rates can really eat into your savings.
It's like a slow leak in your financial tire. You might not notice it at first, but over time it can cause major problems.
Exactly. So, wrapping up Kelly's perspective on leverage, it's all about being mindful and understanding that it's a double-edged sword. It can be a powerful tool for building wealth, but it can also lead to financial ruin if used recklessly.
Kelly's advice is to use leverage strategically and cautiously, always keeping in mind the potential risks. Now let's shift gears and talk about insurance, something that often gets overlooked in those personal finance conversations.
You're right. It's easy to think of insurance as just another expense, but Kelly sees it as essential for protecting your hard-earned wealth from catastrophic losses.
It's like having a financial shield, right? Protecting you from those unforeseen events that could wipe out your savings.
Precisely. He breaks down insurance into three essential types: health insurance, property insurance, and life insurance. Let's start with health insurance. He acknowledges that it's expensive, but he offers some strategies for managing those costs.
Healthcare costs are a major concern for many people, so I'm eager to hear his insights on this.
He recommends opting for a health insurance policy with the highest deductible you can comfortably manage. This lowers your monthly premiums, and you can then put those savings into a health savings account or HSA.
The HSA. It's like a triple tax advantage, right? Contributions are tax deductible, the money grows tax-free, and withdrawals for qualified medical expenses are also tax-free.
Exactly. And Kelly suggests putting half of your premium savings into your HSA each month while using the other half to cover those out-of-pocket expenses that arise from the higher deductible.
So it's like creating your own mini healthcare fund.
Exactly. And Kelly stresses the importance of funding your HSA to the maximum each year, if possible. He sees this as a critical part of protecting yourself from those potentially devastating medical expenses.
It's like building a financial fortress around your health.
Now let's move on to property insurance. Kelly stresses the importance of having adequate coverage to protect your home and other properties from potential damage, especially if you live in an area prone to natural disasters.
This is about making sure you're not underinsured, right? Because if you are, you could be left with significant financial losses in the event of a claim.
You're right. Kelly recommends checking with your insurance company to determine the maximum appropriate coverage for your home and other properties. And he specifically highlights the importance of flood insurance even if you don't live in a designated flood zone.
I've heard stories of people who thought they were covered, only to find out that flood damage wasn't included in their policy. That must be devastating.
Absolutely. And he also reminds us to regularly review our coverage for cars and other properties like boats or motorcycles. As these items age and depreciate, you may be able to lower your premiums without sacrificing essential coverage.
It's about being a savvy consumer and making sure you're getting the best value for your insurance dollar. Now, life insurance is a topic that many people find uncomfortable to discuss, but it's crucial for protecting your loved ones.
You're right. Kelly has a very specific perspective on life insurance. He sees it as renting an estate until you build one.
Meaning that life insurance is a temporary solution to provide financial security for your loved ones until you've accumulated enough wealth to self-insure.
That's exactly right. He emphasizes that you can't afford to completely replace your lost lifetime income with life insurance. It's simply too expensive.
So it's about finding a balance, right? Getting enough coverage to protect your family without creating an undue financial burden.
Precisely. Kelly suggests aiming for enough life insurance to replace at least 3 years of your after-tax earnings. This would provide your family with a financial bridge to adjust to your absence and make necessary transitions.
It gives them time to grieve and to plan for the future without having to make those difficult financial decisions under duress. Now, I know there are different types of life insurance policies. Does Kelly have a preference?
He does. He steers clear of those whole life policies which he sees as overpriced and too focused on building cash value. He prefers term life insurance, which he views as pure insurance, providing coverage for a specific period of time at a fixed premium.
So it's a simpler, more straightforward approach
Yeah.
focused on providing that essential protection without the added costs and complexities.
Exactly. And Kelly suggests aiming for term life insurance coverage that extends through age 65. By that time, if you followed his investment principles, you should have accumulated enough wealth to self-insure, eliminating the need for life insurance.
So it's like a temporary safety net that you gradually phase out as you build your financial independence. Now, we've talked a lot about retirement accounts, but I know Kelly also emphasizes the importance of funding those taxable accounts.
You're right. He sees relying solely on retirement accounts as limiting your financial flexibility.
But aren't those retirement accounts designed to help us save for the future?
They are, but Kelly points out that life is unpredictable. There may be times when you need to access your savings before retirement, whether it's for an unexpected expense, an opportunity that arises, or simply a change in your plans.
I can definitely relate to that. Life rarely goes exactly according to plan.
And if your savings are locked up in those tax-deferred retirement accounts, you could face hefty tax penalties and potentially derail your financial plans.
So it's about having access to your money when you need it, without those tax consequences hanging over your head.
Exactly. Kelly stresses the importance of building up savings in taxable accounts and Roth IRAs. These accounts allow you to access your money without those additional tax burdens, giving you more flexibility to handle life's curveballs.
It's about diversifying your saving strategy, right? Not putting all your eggs in one basket, so to speak.
Absolutely. It's about having those different buckets of savings that can serve different purposes and provide you with more options. He compares it to having a toolbox with a variety of tools, each designed for a specific task.
Okay, that's a great visual. So we've covered a lot of ground here, from the importance of discipline and avoiding leverage pitfalls to managing insurance costs and diversifying your savings.
And through it all, Kelly's main message seems to be about being proactive and taking control of your financial future. It's about recognizing those potential pitfalls and making informed decisions to mitigate those risks.
It's about becoming the architect of your own financial well-being.
Exactly. He's all about empowering investors to take charge of their finances and build a solid foundation for long-term wealth. Now, speaking of foundations, I'm really curious to hear his advice on building those emergency cash reserves because that seems like a crucial first step in his wealth building strategy.
You're right. That's where we'll pick up next time as we continue our deep dive into Kelly's 19 rules for getting rich and staying rich. Welcome back to the deep dive. Let's pick up where we left off, exploring Eugene Kelly's 19 rules for getting rich and staying rich. We were about to delve into Rule 14, which focuses on building those all-important emergency cash reserves.
Yes, these reserves are your financial safety net. It's that cushion to help you navigate those unexpected bumps in the road. The car breaks down, you face a sudden medical expense, or maybe a job loss occurs. These things happen and you want to be prepared.
It's about having that peace of mind, knowing you can handle those situations without having to tap into your investments, or worse, rack up high-interest debt.
Exactly. Kelly emphasizes that these cash reserves are distinct from your investment portfolio. Their purpose isn't to generate high returns, but rather to provide a readily accessible source of funds when you need them most. He recommends having enough to cover 6 months of your operating income after taxes and deductions.
6 months. That feels like a good target to aim for. It gives you some breathing room to adjust and make a plan without making rash financial decisions. But where should you keep these reserves? Under the mattress doesn't seem very practical.
He suggests keeping them in low-risk liquid investments. Think short-term U.S. Treasury notes or bills and FDIC-insured certificates of deposit, also known as CDs.
So it's about preserving capital and ensuring easy access to those funds when you need them. No risky maneuvers with the emergency fund.
Got it. Now I found Rule 15 to be quite empowering. It's about taking control and managing your own investments.
Kelly encourages investors to become actively involved in managing their investments rather than blindly trusting their financial future to someone else.
He's advocating for becoming the CEO of your own financial portfolio. I love that idea. It's about taking ownership and becoming knowledgeable about the decisions being made with your money. Now, this doesn't mean you have to do everything yourself. Kelly emphasizes the importance of finding an investment advisor who understands your goals, shares your investment philosophy, and is willing to work with you as a partner.
It's about finding someone who's on the same page as you, not just trying to sell you a product or push a particular agenda.
Right. Kelly recommends looking for a registered investment advisor, or RIA, who is held to a fiduciary standard.
Ah, yes, the fiduciary standard.
Yeah.
That means they're legally obligated to act in your best interest, which is crucial. It helps avoid those situations where an advisor might be incentivized to sell you products that generate high commissions for them, but might not be the best fit for you.
Exactly. And Kelly emphasizes open communication with your advisor. Clearly articulate your expectations and desires. He even suggests providing them with a written investment policy statement outlining your goals and risk tolerance.
So it's about setting clear boundaries and making sure everyone's on the same page from the outset. Now, how does Kelly suggest allocating those investments once you've got your advisor on board?
He offers some guidance on asset allocation, suggesting investors split their investments contributions and investment income 70% into common stocks and 30% into fixed income assets.
So maintaining that balanced approach even as market conditions change.
Precisely. He believes this allocation provides a solid foundation for long-term growth, balancing the potential for higher returns from stocks with the stability and income generation of fixed income investments.
It's about finding that sweet spot between risk and reward.
Right. And he stresses sticking with this allocation over the long term, resisting the temptation to chase performance or make knee-jerk reactions based on short-term market fluctuations.
It's about trusting the process. Now, does he ever suggest deviating from this 70-30 split?
He does acknowledge that there might be times when it's necessary to adjust slightly. For example, if the stock market experiences a significant decline, you might temporarily shift a larger portion of your new contributions and income reinvestment to stocks to take advantage of those lower prices.
So being adaptable while still maintaining that core asset allocation strategy, it's not about rigidly sticking to a formula, but rather making those strategic adjustments as needed.
Exactly. Now let's move on to Rule 16, which focuses on building a logical real estate investment strategy.
This is where things get tangible. I'm ready to dive into the world of bricks and mortar.
Kelly believes your primary residence should be your first real estate investment.
It makes sense. Housing is a major expense for most people, and owning your own home can provide stability and build equity over time.
He emphasizes buying a home that you can comfortably afford, avoiding the temptation to overextend yourself financially. Remember, this is a long-term game.
So being realistic about your budget and your long-term goals. No champagne dreams on a beer budget.
Exactly. And when it comes to financing, Kelly recommends opting for the largest possible 30-year fixed-rate mortgage you can qualify for.
This echoes his advice on leverage right. Locking in that fixed interest rate for the long term to provide stability and predictability.
Precisely. Now, here's where Kelly's advice might surprise you. He suggests looking for the smallest, oldest, and most in need of upgrading house in the best neighborhood you can afford.
Wait, really? That goes against what I've always heard. Most people would probably gravitate toward the newest, most updated house they can find.
Right, but Kelly's rationale is that most of the value in a home is tied to the land, not the structure itself. So you're essentially buying a great location at a discounted price with the opportunity to gradually upgrade and customize the house to your liking over time.
It's like buying a diamond in the rough and polishing it over time. You're not just buying a house, you're investing in a location and building equity through those upgrades.
Exactly, and he believes this approach can lead to greater long-term appreciation. You're not only increasing the value of your home, but you're also creating a space that's truly tailored to your needs and preferences.
So much more satisfying than just buying something cookie cutter, right?
Absolutely. And Kelly also cautions against the common trap of constantly trading up in the housing market.
Ah, yes, the keeping up with the Joneses mentality.
He points out that each time you sell a home and buy another, you incur significant transaction costs, including realtor fees, closing costs, moving expenses, and often those unexpected renovation costs.
It's easy to get caught up in that cycle of upgrading, but those costs can really add up and eat into your wealth building potential.
You're right. He encourages homeowners to stay in their homes for as long as possible, maximizing their equity buildup and minimizing those unnecessary transaction costs.
It's about letting that compounding effect work its magic in the real estate market as well. Now, I know Kelly focuses primarily on your primary residence, but does he ever talk about investing in additional properties?
He does briefly touch on investing in rental properties or vacation homes. He applies the same principles of buying a primary residence, emphasizing the importance of carefully analyzing the costs and potential returns before taking that leap.
So no rushing into those decisions. It's about approaching real estate investing with the same discipline and long-term perspective that you would apply to any other investment.
Exactly. And now let's move on to Rule 17, which focuses on building a simple fixed income strategy.
Okay, back to the world of bonds. I have to admit, this area has always felt a bit intimidating to me.
I understand. It can seem complex, but Kelly breaks it down in a way that's easy to grasp. He's a firm believer in the importance of fixed income investments, regardless of the prevailing interest rate environment.
So even when interest rates are low, as they have been in recent years, he still sees a role for bonds in a well-diversified portfolio.
Absolutely. He views fixed income investments as a source of stability and income generation, providing a counterbalance to the volatility of stocks.
It's about having that ballast in your portfolio to help you weather those market storms.
Exactly. And he emphasizes the importance of understanding the key characteristics of fixed income securities, such as maturity dates, interest rates, credit quality, and those potential early redemption features.
So it's about being an informed investor and not just blindly following someone else's advice.
Right. Kelly provides a specific framework for building a fixed income portfolio. He suggests that the maturity dates of the bonds you select should align with the yield on the 10-year U.S. Treasury note.
Okay, help me out here. Why the 10-year Treasury? What's so special about it?
It's often seen as a benchmark for interest rates in general. So Kelly's strategy is essentially to use this benchmark to guide your fixed income investment decisions. If the 10-year Treasury yield is low, he recommends focusing on shorter-term bonds. And as that yield rises, you can gradually shift toward longer-term bonds.
So it's like a roadmap for navigating the fixed income market.
Exactly. And he provides specific yield ranges and corresponding maturity ranges to help investors make those decisions.
That's helpful. It takes some of the guesswork out of it. Now, I know diversification is key for stocks. Does Kelly apply the same principle to bonds?
He does. He recommends including U.S. Treasury securities, corporate bonds, and corporate preferred stocks in your portfolio.
So spreading your risk across different types of fixed income investments.
Right. Now, here's another point where Kelly's approach might differ from what you typically hear. He's very clear about his preference for individual bonds over bond mutual funds or exchange-traded funds or ETFs.
Interesting. Why is that? I thought bond funds were a good way to diversify.
Kelly believes that bond funds can introduce unnecessary risks and complexities, especially for investors seeking stability and income generation. He prefers the predictability and control that comes with owning individual bonds.
So you know exactly what you're holding, and when those bonds will mature, there are no surprises.
Exactly. And he provides specific guidance on selecting those individual bonds, emphasizing the importance of sticking with investment-grade securities and choosing bonds with maturity dates that align with your investment time horizon.
It's about building a fixed income portfolio that meets your specific needs and risk tolerance. Now, I know there are risks associated with bond investing. What are some of the things that investors should be aware of?
Kelly addresses two primary risks: credit risk and inflation risk. Credit risk is the risk that the issuer of the bond might default on their payments.
So the company or government essentially goes bankrupt and can't pay you back.
Right. Kelly mitigates this risk by sticking with investment-grade bonds, which are issued by companies or governments with strong credit ratings. He steers clear of those high-yield or junk bonds, which carry a higher risk of default.
So it's about prioritizing safety and reliability over those potentially higher yields.
Exactly. Now, inflation risk is the risk that the purchasing power of your investment will erode over time due to rising prices.
That's a big concern these days, with inflation being a hot topic.
You're right. And Kelly addresses this risk by recommending a laddered approach to bond maturities.
Okay, I've heard that term before, but I'm not sure I fully understand it. Can you explain?
It means holding bonds with a range of maturity dates. As some bonds mature, you can reinvest those proceeds at potentially higher interest rates if inflation is rising.
So it's like a rolling reinvestment strategy that helps you stay ahead of inflation and maintain the purchasing power of your fixed income investments.
Precisely. Now let's move on to Rule 18, where Kelly delves into building an effective common stock strategy.
All right, back to stocks. This is where things can get a little more exciting and maybe a bit more intimidating.
You're right. Stock investing is often portrayed as this high-stakes game of speculation and guesswork. But Kelly takes a very different approach.
He's all about taking the emotion out of it, right? Making those decisions based on logic and analysis, not fear and greed.
Exactly. He encourages investors to view stocks as ownership stakes in real businesses, not just pieces of paper to be traded.
It's about becoming a part owner of those companies, sharing in their success, and participating in their long-term growth.
Precisely. And this mindset shift is crucial because it helps you make investment decisions based on sound fundamental analysis rather than fleeting market trends or those emotional impulses.
So it's about looking beyond those short-term price fluctuations and focusing on the underlying business fundamentals.
Right. Kelly provides a framework for evaluating those fundamentals. He emphasizes understanding a company's financial statements, including the balance sheet, the income statement, and the cash flow statement.
Those statements can seem a bit daunting, though.
They can be, but Kelly highlights some key metrics to focus on, such as return on equity, debt-to-equity ratio, and dividend payout ratio.
So these metrics give you insights into a company's profitability, its financial leverage, and its commitment to returning value to shareholders.
Exactly. Now, beyond the numbers, Kelly stresses the importance of evaluating a company's management team. He looks for companies with experienced ethical leaders who have a proven track record of success.
It's about finding those companies that are well-managed and aligned with your values.
Absolutely. He also encourages investors to research a company's history, its industry, and its competitive landscape to get a better understanding of its long-term prospects.
So doing your due diligence, not just blindly jumping into investment based on a hot tip or a fleeting trend.
Precisely. Now, once you have a good understanding of the business, Kelly guides you on valuation. He emphasizes buying stocks at a reasonable price, avoiding those companies that are overvalued by the market.
It's like finding those hidden gems, those companies that are trading below their intrinsic value.
Exactly. And he suggests using a variety of valuation metrics, such as price-to-earnings ratio, price-to-book ratio, and dividend yield.
These metrics help you compare a company's valuation to its historical averages, its industry peers, and the overall market.
Right. It's about finding those companies that are attractively priced relative to their earnings potential and their asset value.
So it's a combination of fundamental analysis, management evaluation, and valuation assessment.
Exactly. Kelly's approach is all about making informed investment decisions based on a thorough understanding of the businesses you're investing in.
Now, once you've identified some promising companies, does Kelly have any advice on how to build a well-rounded stock portfolio?
He stresses the importance of diversification, spreading your investments across different industries and sectors to mitigate risk and smooth out those inevitable market fluctuations.
That makes sense. Don't put all your eggs in one basket, as the saying goes.
Exactly. And he provides some guidance on sector allocation, suggesting investors consider the long-term growth prospects and the cyclical nature of different industries.
So it's about building a portfolio that's well-balanced and positioned to weather those economic storms.
Precisely. Now, even with the most thorough analysis, investing can still be an emotional roller coaster.
Oh, tell me about it. It's hard to stay rational when the market is going haywire.
Kelly recognizes this and offers some practical advice for managing those emotions. He emphasizes having a long-term investment plan and sticking to it regardless of those short-term market fluctuations. It's about staying disciplined and focused on your goals, not letting those emotions dictate your decisions.
Right. He also encourages investors to tune out the noise and avoid getting caught up in those market predictions and those speculative frenzies.
That's good advice for life in general, I think. It's about staying grounded and making decisions based on sound analysis and your own individual circumstances.
Now let's move on to the final rule, Rule 19, which focuses on using careful tax strategies.
Tax is the unavoidable part of investing. I'm all ears for any tips on minimizing their impact.
Kelly starts by emphasizing utilizing those tax-advantaged retirement accounts, such as 401ks and IRAs.
Those are the accounts that allow you to defer taxes on your contributions and earnings until retirement, right?
Exactly. And Kelly also encourages investors to consider Roth IRA accounts, where contributions are made with after-tax dollars, but withdrawals in retirement are tax-free.
So it's about having those different buckets of savings that can serve different purposes and provide more flexibility in managing your tax liability. Right. He also highlights a strategy called tax loss harvesting.
This is about strategically selling those losing investments to offset the capital gains you might have realized from winning investments, right?
You got it. This can help reduce your overall tax bill for the year.
It's about being proactive and strategic about managing your tax liability.
Kelly's advice is to consult with a qualified tax advisor to develop a plan that aligns with your individual circumstances and investment goals.
Sound advice. So as we wrap up our deep dive into Kelly's 19 rules for getting rich and staying rich, it's clear his approach is all about taking control of your financial future.
He's a strong advocate for becoming an informed, engaged investor who makes decisions based on sound principles and a long-term perspective.
He's not promising get-rich-quick schemes, but rather a path to sustainable wealth built on disciplined patience and those time-tested investment strategies. His message feels particularly relevant in today's environment where there's so much noise and hype in the financial markets.
It's about tuning out those distractions and focusing on those fundamental principles that have stood the test of time.
And one of the most valuable takeaways is that anyone can achieve financial success if they're willing to put in the effort and follow those proven strategies.
It's about empowering yourself with knowledge, making informed decisions, and taking consistent action to build a brighter financial future.
And before we go, if you're looking for extra resources to expand your financial knowledge, check out lingopediamagazine.com. They offer some fantastic courses and ebooks that can help you on your journey.
And don't forget to subscribe to our channel, share this episode with your friends, and give us a like if you found this deep dive valuable.
Thanks for joining us today, and we'll see you next time on The Deep Dive.